let's talk about the holy grail of investing, shall we? We're going on a hunt today. A hunt for those incredibly rare, almost mythical stocks that can return not just 10 times, but maybe even 100 times your initial investment. Now, I know that sounds crazy ambitious, and it is, but it's not impossible. So let's dive in and figure out how to find these legendary multi-baggers. We can kick things off with a quote that is basically the entire game plan in just 5 simple words. It comes from Thomas Phelps' classic book, Buy Right and Hold On. It sounds so basic, doesn't it? But it's everything. Buying right, well, that's the skill part. That's the analysis, the homework, and we're going to break all that down. But that second part, hold on, man, that's the real battle, isn't it? That's the test of your nerve, your patience, your conviction. It's where almost everyone gets tripped up, and it's the real key to unlocking these kinds of massive returns.
So what are we really talking about here? A 100 bagger. What does that even look like in percentage terms? Well, it looks like this, 10,000%. Just take a second to let that number sink in. This is the kind of return that can take a $10,000 investment and turn it into a cool $1 million. I mean, that's life-changing stuff, right? It captures the imagination for a very good reason. Now, is it easy? Absolutely not. But is it possible? You bet. And the sources are clear that with the right strategy, and just as importantly, the right amount of time, it's achievable.
Okay, so here's our roadmap for today. Think of it like a funnel. We're going to start wide with the big picture, the 100x dream itself. Then we'll narrow it down to where we should even be looking for these things, the fertile ground. After that, we'll get our hands dirty with the numbers, decoding the financials. Then we'll zoom back out and look at the story behind those numbers. Next, and this might be the most important part, we'll talk about getting your head right, the investor mindset. And finally, we'll tie it all together into a repeatable process that you can actually use. All right, let's jump right into part 1, the 100x dream. Because, look, before we go out hunting for this mythical creature, we've got to understand what it is, right? We have to understand the nature of the prize. And, spoiler alert, it requires a whole lot of patience. So this word multi-bagger, it comes from the one and only Peter Lynch, a true investing legend. The idea is super simple. A 10-bagger is a stock that goes up 10 times. A 100-bagger goes up 100 times. Easy enough. But I want you to focus on that last sentence there. Let it really sink in. 20 to 25 years. This is not a lottery ticket. This is not a get-rich-quick plan. It's a marathon. A really, really long one. So patience isn't just a good idea here, folks. It's the whole dang strategy.
Okay, so we've got our expectations set. We know this is a long-term game. So let's move on to part 2. Where do we even begin to look? The stock market is huge, right? There are thousands and thousands of companies. We can't possibly analyze them all. To have any chance of success, we've got to be smart about it and focus our energy where these future giants are most likely to be hiding. We've got to hunt in fertile ground.
So do we look at the giants like Apple, or do we look somewhere else? Well, the math makes this decision pretty simple. For a company like Apple to 100x from where it is today, its valuation would have to swell to something like $300 trillion. That's more than the entire global economy. It's just not going to happen. But now, look at a smaller company, maybe one that's worth $500 million. For it to become a 50 times billion-dollar company, well, that's still an incredibly steep climb, don't get me wrong, but it is actually in the realm of possibility. And here's the real kicker. Wall Street often isn't even looking at these smaller guys. That's our opening. That's our advantage. So we're focusing on small companies. But which ones? We need to narrow it down even more. We're looking for what you might call hotbeds of innovation. We're hunting for companies right at the center of huge, world-changing trends. You know what I'm talking about. Artificial intelligence, new kinds of software, breakthroughs in biotech and genomics, the massive global shift to clean energy, and just the unstoppable move of everything online. We are looking for companies that aren't just competing in an old market, they're creating entirely new ones. And here's another piece of absolute gold from Peter Lynch. This one's huge. Invest in what you know. What does he mean by that? He means that your own life, your job, your hobbies, your passions, that's your secret weapon. Maybe you're a doctor and you see a new medical device that's a total game changer for your patients. Maybe you work in construction and your company just started using a new software that's saving you tons of time and money. That's your signal. That's your edge. You see these things way, way before some analyst sitting in a skyscraper in New York ever will. Pay attention to that. So let's say we've done all that.
We've found a cool little company in a booming industry. Maybe it's even something we know about personally from our own lives. That's a fantastic start. But a good story, as compelling as it might be, just isn't enough. We have to see if the numbers back up the story. So for part 3, we're grabbing our toolkit and we're going to decode the financials. It's time to get into the nitty-gritty.
Okay, think of this as your financial health checklist. These are the non-negotiables, the things we absolutely have to see. First, we need explosive revenue growth. And not just a one-time pop. We're talking consistent growth, ideally over 25% a year. But sales alone don't cut it. That money has to turn into actual profit, which means we need to see strong growth in earnings per share. And here's a golden rule for you. Over the long haul, stock prices always follow earnings. It's that simple. Then we ask, is the company actually good at making money? We check that with profit margins and return on equity. And last but certainly not least, we check their debt. A company drowning in debt might not survive a tough year. We are looking for a clean bill of health.
All right, so the company looks great. It's growing like a weed. But is it too expensive? How do we figure that out? Well, there's this really fantastic tool called the PEG ratio. The best way to think about it is as a growth-adjusted price tag. It's a way to figure out if you're getting a good deal on all that growth. It's really simple. You just take the standard PE ratio and you divide it by how fast the company's earnings are growing. The magic number we're looking for is anything below 1. That's our signal that the price we're paying is actually pretty reasonable, or maybe even cheap, compared to how fast the company's expected to grow.
Okay, we've done the science part. We've crunched the numbers, we've looked at the ratios. But that's really only half the story. The numbers tell you what's happened in the past. Now for part 4, we have to put on our detective hats and try to figure out what might happen in the future. This is the art of investing. This is where we read the story behind the numbers.
I absolutely love this concept from the author Chris Mayer. He calls it the twin engines of returns. Imagine a rocket trying to get to the moon. To get there, you need 2 things to happen at once. First, you need engine number 1. The company has to be making more and more money year after year. That's the raw power, that's the fuel. But that alone isn't enough for liftoff. You also need engine number 2. Wall Street and other investors have to notice this incredible growth and get excited about it. When they do, they start paying a higher price for every dollar the company earns. When you get both of those engines firing on all cylinders, real profit growth and growing market excitement, that's when a stock can really take off into the stratosphere.
You've probably heard the saying, bet on the jockey, not just the horse, right? It is so incredibly true in investing. The leadership team is everything. So what do we look for? Well, it really helps if the founder is still running the show. Founders just have a level of passion and a long-term vision that's hard to replicate. We also want to see that the managers own a ton of the stock themselves. It's called skin in the game. It means if they win, we win. If they lose too. That aligns everyone perfectly. We also want to look at their track record. Are they smart about how they invest the company's money? And finally, are they straight shooters? Do they communicate honestly with you, the shareholder? We need leaders we can trust for the long haul. Okay, next question, and this one is huge. Does the company have a moat? You know, like a moat around a medieval castle? It's a defense system. It's what keeps the competitors from storming the walls and stealing the profits. So what does a moat look like in business? Well, it could be a brand that everyone knows and trusts. It could be that their product is so integrated into their customers' lives that it's just a huge pain to switch to a competitor. Or maybe they just have some secret sauce, some proprietary technology that nobody else can copy. Whatever it is, we need to see a strong, durable competitive advantage that can protect this company for years and years to come.
And one last thing on the story side of things, just how big is the opportunity? This is what investors call the total addressable market, or TAM. I really like the runway analogy. You could have the most powerful jet engine in the world, but if the runway is only 100 feet long, you're never getting off the ground. It's the exact same for a company. For a business to grow 10, 50, or 100 times its current size, it needs a massive, wide-open market to grow into for decades. We are looking for companies playing in gigantic sandboxes with plenty of room to run.
All right, we've analyzed the numbers, we've analyzed the story, we have done all the homework. But now we get to what is, without a doubt, the single most critical piece of this entire puzzle. This is the part that trips up almost everyone. Part 5 is all about what goes on up here, in your head. It's about forging an unbeatable investor mindset. So, where is your real advantage as a regular investor? Check this out. You're probably not going to have an informational edge. You're not going to know more secrets than the pros on Wall Street. And yeah, you can get really good at analyzing stuff. That's your processing edge. But your true, honest-to-goodness superpower is this big piece of the pie right here, your temperamental edge. So what is that? It's your gut. It's your ability to stay calm when everyone else is freaking out. It's having the patience to just sit there and do nothing while the market goes completely haywire. That, right there, that accounts for maybe 70% of your success. It's your winning ticket.
And this quote right here, this is exactly why that temperamental edge is so crucial. Let me be totally straight with you. The journey to a 100x return, if you're lucky enough to find one, will be a brutal roller coaster. The stock you own is going to crash. I don't mean if, I mean when. It'll drop 30%, 50%, maybe even more at some point. And every single fiber of your being is going to be screaming at you to sell, to just get out, cut your losses, or lock in a small profit. But you have to burn this quote into your memory. The costliest financial mistake most people make isn't buying the wrong stock. It's buying the right stock and selling it way, way too soon because they got scared.
So let's bring all this home. We've covered a ton of ground, from the math to the mindset. So for our last section here, we're going to boil everything we've learned down into a simple, repeatable process that you can take with you and use again and again. And here it is, the entire framework, distilled into 4 disciplined steps. Step 1, you hunt. You go looking in the right places, small, innovative companies that are literally changing the world. Step 2, you do the math. You check for that rapid growth, you make sure they're actually making money, and you don't overpay. Step 3, you check the story. Is the management team top-notch? Do they have a deep moat to protect them? Is their market absolutely huge? And finally, step 4, which holds it all together, you hold. You cultivate the patience and the conviction to let the story play out over years. See, finding these companies isn't about getting lucky. It's about discipline. It's about following the process. Now, one last super important piece of advice here. Please do not go bet the farm on a single idea. That's not investing, that's just gambling. The hard reality is that even if you do everything right, most of these high potential companies will not make it. Some might even go to zero. So you have to think of yourself more like a venture capitalist. You're not making one big bet, you're making a bunch of smaller, smart bets. You build a diversified portfolio, a whole basket of these promising companies. Because all you need is 1 or 2 of those massive winners to more than make up for all the losers, and then some. Diversification is your safety net. Don't forget it. So we end with this. The process, the how-to, is actually pretty clear. The steps have been laid out by great investors for decades. And the analysis part? That's a skill you can learn. The true challenge, the real question, it has nothing to do with finding the perfect stock. It has everything to do with you. The question isn't, can you find the next great company? It's, can you hold it? Do you have the stomach, the discipline, the sheer willpower to hang on for 10, 15, maybe even 25 years while the world goes crazy around you? That is the ultimate test, and that's the question you have to answer for yourself.